Hello and welcome to Moneylife News and Views. I am Debashis Basu. This is my third piece in a series which explains why the stock market, which should ideally reflect the underlying economy, is so resilient in the face of global pandemic. The first piece pointed out the extraordinary corporate earnings as the main reason. The second, last fortnight, was more macro, explaining that at least a dozen large sectors, cement, chemicals, software, textile, steel, building materials, etc., are all simultaneously doing extremely well, each for very independent reasons. This piece goes further in looking at the macro scenario to explain why we need to look at a different set of data to make up our minds whether economic activity as a whole is shrinking or not. After all, technology is allowing us to get faster and better macro data. On 1st April this year, the government announced that collections from the goods and services tax hit a record high of 123,000 crores. From September 20 to March 21, GST collections were higher every month compared to the same months of the previous year. Over the whole year, the GST shortfall was about 85,314 crore. This was due to just 1 month, that is April 2020, when the country as a whole was under a complete and a strict lockdown. That month, GST collection was down by about 82,000 crore. In short, if you remove April from the calculations, economic activity in financial year 2021 as measured by GST collections has been the same as FY 2021. And yet, FY 1920. And yet, on 31st May, when the government announced that India's gross domestic product contracted by 7.3% in 2021, commentators started shaking their heads again and pointed out how irrational the stock market is, and that is flying high in the face of gloom and doom based on the GDP figure and anecdotal stories of healthcare crisis, rising unemployment, and the real impact on small businesses. Leaving aside anecdotal evidence, which is irrelevant in the macro context, my question is, which data would you trust more? There is a reason why I have mentioned the dates for GST and GDP data earlier. Notice that the GST data of the month and the year were available 1 day after the year ended, that is on 1st April. A giant macro data point reflecting countrywide economic activity was available in a day. This is called high frequency economic data, and it's improving every day. Mind you, this is not an estimate, this is real-time data based on actual transactions. What about the GDP data? For one, it's too late. The FY21 data of GDP growth was released 2 months later. Secondly, it is an estimate of economic activity. I'm not sure what kind of work goes behind this, collecting this data. In the March quarter, when businesses were functioning more or less normally and companies across the board, except a few sectors like automobiles, reported bumper profits, GDP was reported to have grown by just 1.6%. Could there be some flaw in the collection and analysis of GDP data which is so depressed when almost all core industries and large chunks of the services sector are doing so well? Like GST, there are other data points which are much more reliable than GDP data because they are not estimates. This is real data which is recorded very precisely, such as electricity consumption, which was higher in February this year under conditions of partial lockdown than it was in February last year, when the economy was fully open. Among the data that are estimates, a more reliable piece of data is Purchasing Managers Index. This is based on monthly survey of supply chain managers across a dozen or so important industries, covering both upstream and downstream activity. The PMI data showed continued expansion of the economy from August 20 right until April 21. This is why the market started climbing from late May last year. Another example is data showing automobile sales. Earlier, data from the Society of Automobile Manufacturers was watched, but this is flawed because it showed dispatch from the factory gate to dealers and not actual sales. Now we have automobile registration data available from the Federation of Automobile Dealers Association. This is more reliable because it proves actual sales which have to be completed before automobile registration. In short, the data that market players watch is a different set and it is available faster, not GDP data, which tends to be iffy. Technology has changed how we collect data and which data set is more reliable. The whole process of collecting ground level data and feeding into a model to spit out the GDP growth rate after 2 months, which could be revised later, is out of sync with the technology driven economy that India is becoming. The market understands this well, even if commentators don't. I am not for a moment saying that since the market is doing well, the economy must be doing well too. That would be a perverse logic. All I am saying is that the large investors track high frequency data that is immediately available today. That data has been bullish. As and when that data shows negative trends and corporate earnings begin to stagnate, the market will fall. It will not decline based on anecdotal reports in the media. Thanks for watching. If you like this video, please do click the subscribe button. Thank you.